Hi, everyone. I'm Doug Alsdorf. I have been teaching a one credit class at The Ohio State University for about 6 years now that is on personal finance, and it's taught to first year students. During our conversations, we often spend a few weeks on investing, and I'd like to condense that into this presentation to share with you today. As always, in these types of things, there's a limit of liability and there's a copyright. So please pause and read this. I'm Doug Alsdorf. My PhD is in geophysics from Cornell. I am not a academically trained finance person. So why should you listen to me about personal finance? Honestly, you should not listen to me. You should listen to the data. And that's what we're going to do in the next series of slides. We're going to look at models and measurements. In science, we deal with models and measurements, whether we're biologists, astronomers, any kind of science that we're doing. There'll be some of those scientists who work with models, some who work with measurements. And here we're going to take that kind of approach to look at finance, and in particular, to look at investments that we should do in equities. And in particular, this whole talk is all about equities rather than bonds and some of the other assets that you might want to own. The most important slide I show you is going to be this slide. I want you to read books. These three books, I highly recommend these three books to you. In fact, this one by Jim Daly was the first one I ever read on finance, and I think it's an excellent book, even though it's directed at those in the medical profession. My book is always freely available to you, as well as the spreadsheets that I'm going to show you. So please read it, particularly these two books. The outline for today is we're going to talk about three things. One, how much money do you need for retirement? Models that will suggest us how to achieve that investing goal, and then we'll look at measurements of the past to see how well the models might work. So those are our 3 points here. Now, one of the things that I ask my students is, why are you investing? I hope to convince you that you should be investing for your retirement, and therefore, hopefully, that's a long timeline for you. Anytime you're given a plot, I want you to look at the axes. No matter whether it's in this lecture or any lecture that you experience, please look at the axes. And across the bottom, we have your age across the bottom. So you're starting at age 65. On this side are millions of dollars that go with the green lines, and over here are hundreds of thousands of dollars that go with the blue line. What you're looking at is your investments in green line versus the withdrawals in the blue line in your retirement. So here at age 65, I'm going to suggest you'll want to withdraw $121,000 a year, growing at the rate of inflation, which we're going to just assume is about 2% a year. We can talk about how much that actually is if you'd like, but that's a starting point for our investigations. And as always, I give you the spreadsheet so you can adjust this content directly for your purposes. Why $121,000? Well, if we look at today's students who are graduating from college are starting out at about $55,000 per year. That's an average across the United States, across all majors. And so therefore, it's quite a range of averaging. And it wouldn't surprise me at all that many of you listening to this are making less than that, and many are making more. So it's a starting point. Because I don't know you, I don't know how much money you need to have in your retirement. But I'll make the suggestion that you would at least like to do better in your retirement, or at least as well as you're doing right now when you first graduate. So when you first graduate, let's say you're making $55,000 per year, and let's say 40 years in the future, you want to then still have that same purchasing power. So we're going to grow $55,000 at 2% a year, which is about the inflation rate, maybe a little less than the actual inflation rate, but it's a starting point. And so 40 years, growing at 2%, 55,000 becomes 121,000. And we're going to continue to grow that right along through there throughout these 30 years of your retirement. Now, let's say you have $1 million invested by the time you retire. And whether this is 40 years in the future or 20 years in the future, you can, again, just take this model and do the math, and you'll see that it's the same here. And so we have this $1 million investment and living on $121,000 a year. And we see the $1 million investment runs out by the time you're 75 years old. Each one of these green lines is growing at 5% a year while subtracting off the growing blue line, which grows at 2% a year. Well, okay, so let's say you just have $1 million and you want to live on $100,000 per year. Well, that will last for 10 years. 100,000 times 10 is a million. Clearly, $1 million is not enough in retirement. $2 million is going to last while subtracting off the blue line. $2 million will last somewhere into maybe your latest or latest 80s and into your early 90s. We might be able to push this over by subtracting off less and less as you get older and older. What we then see is that $3 million will indeed last throughout your entire retirement, living off from this equivalency to what you might expect when you first graduated. So what is the moral of this story is that basically anyone watching this video needs $2 million invested by the time you retire. That's a lot of money, and it's sobering to think about. Fortunately, I think you can get there, and I'm going to show you how to do that. And we're not going to use weird things like Bitcoin or anything like that. We're actually just going to invest in the S&P 500. I'm going to show you how that works. I do think Social Security will exist in the future. You can read my book for some content on that. And so we're not talking about Social Security in this presentation, but I still think you're going to need that $2 million. I'm going to show you how I think you can get there. So we can use models to describe how you might get there. And there's going to be two end members. We're going to use this model showing a lump sum approach, and then we're going to use another model in the next slide showing you how to invest year after year after year. So this lump sum approach is, I'm going to assume one end member, that's pretty worst case scenario, where maybe you're 40 in your mid 40s and you're going to retire 20 years later, and hopefully you have $300,000 to invest in, let's say, an investment that'll grow at 10% a year. The S&P 500 from 1935 to present has averaged 10.5% when reinvesting dividends. And that's still, I mean, I'm a little cautious about this, but $300,000 per year invested once at the beginning, 20 years later, growing at 10% a year, will reach $2 million after 19.9 years. That's what this Formula 2 allows you to do. And you can, of course, adjust all this. So this is challenging for us. First off, we're counting on 10% a year. Yet in the last 20 years, from 2000 to 2020, the S&P 500 is more like 6 to 7%, depending upon how you calculate that. So clearly not 10%. And it also assumes you have $300,000 available to invest. You might, but again, I give you the spreadsheet so that you can adjust this lump sum approach. We will look at measurements using a lump sum approach, but with $50,000 as our starting point. How about a different approach? Let's invest $7,000 per year. So instead of doing a lump sum, do it year after year after year. So if you have $7,000 to invest year after year after year, and you're going to increase that $7,000 by 2% a year, just a little bit per year, and you're going to invest for 40 years, and you're going to hope for a 7.5% return on investment. So we go to Formula 4 in the spreadsheets, which you can download. We're going to hope for an investment growth. Instead of hoping for 10.5% from the S&P 500, we're going to hope for 7.5%. So conservative in comparison. You're going to invest $7,000 per year, and I think most people can find $7,000 per year. Growth rate on that contribution, you're going to keep increasing it by 2% a year for 40 years, and you will have $2 million. So this is the other end member of our investments, and I want you to put that in your IRA. $7,000, as it turns out, is the maximum you're allowed to contribute to your IRAs, and generally it grows by about 2% a year in terms of what the government mandates, so you're allowed contributions. Okay, so those are our end members. Those are our end members. Now, I think what we want to do is go ahead and have a look at measurements from the past. So that was a model looking at lump sum versus year after year contributions, investments. Now let's look at the measurements of the past to see how well those models actually worked, at least in the past. Always remember, though, throughout the following slides, I can't predict the future. Nobody can predict the future. And there are very much cautionary tales that we can share with each other about, you know, you go on those web pages and there are people there thinking they're predicting the future. So be very careful about listening to any of that stuff. We're going to have a look at what happens when a person just focuses on a few stocks. And essentially that's gambling. It's very high risk if you're just buying a couple of stocks. We're going to look at some examples. Or we're going to also have a look at what happens if you hire a professional to do this for you. What do they do? And can you replicate that yourself and save some money along the way? I'm going to break this presentation up into 3 videos. I want to cut them short enough so that when you download them, you're not having to download a massive video. So I'm going to cut the video here and pick this back up on the next slide. So continuing along with our journey of looking at investments, now let's have a look at individual stocks right now. So let's pretend that it is January of 2015, and you've been talking to your friends about investments, and everyone's getting excited about stocks, buying individual stocks, or perhaps even individual things like Bitcoin and so on. But let's pretend it's now January 2015, and some people are getting excited about Starbucks and Chipotle, just as a for example. And this is an example. We can do this with many, many different stocks or many, many different investments. And so what you're looking at in these two plots, these two lines, I should say, is along the x-axis, we have time from 2000, the year 2007 to January of 2015, and then the percent gain in the stock price. So here we see that Chipotle lost some money and then finally started gaining money, or I'm sorry, Starbucks lost some money and then finally started gaining money, whereas Chipotle generally was gaining, and it went up by 1,000% in that 7-8 year period, whereas Starbucks only went up by 143%. So we're looking at percent gains and losses in the value of these stocks. And what happens to us as young and early investors who are just starting out is we see these plots and they're very powerful because it looks like it's a no-brainer that in January 2015, you buy the one that's going up. That just seems like a no-brainer. It's just going to keep going up. So buy that one. It ought to be easy. I'm going to show you it's actually not. And this is the actual data showing you this. By the way, there's also an assessment, a quantitative assessment of risk. What is the risk factors here? And the quantitative definition of risk that many of us use is the standard deviation, the variance, how much it's going up and down. What's the wiggle on this value? And both of these values in terms of the risk are fairly similar overall. And it's easy enough to look at this and say, well, that one's going up. The blue line's going up. That's Chipotle. It's January 2015. Buy Chipotle. And so you do. And now here we are more recently, and we bought it in 2015, and we see that Chipotle went down while Starbucks went up and Starbucks continued to do better than Chipotle even till very recently. Wow, what happened? Well, in 2015, that was when Chipotle went through a food poisoning incident and their stock went down while Starbucks, for whatever reason, it climbed. In other words, when it was in January 2015, we could not predict a food poisoning incident. You can't. And that's the problem with any individual investment, particularly a stock. You can't predict its individual future. For example, maybe you think, well, maybe I should buy a car company. What happens if they have a recall? Then their stock might go down. A banking stock, for example, could have bad loans that they issued. These are things that we can't predict in the future. So here we see what happened is 2015, Chipotle went down, where Starbucks went up. Maybe we have a third friend who just procrastinated and waited till 2016. They just held out for 1 year and then bought Chipotle. Well, they came out ahead. Man, we're beginning to see that timing the market might be the answer. But this is only evident when looking in the past. Right now, here it is in 2024. Can you predict the future of Starbucks or Chipotle and therefore which one you should buy? No, you can't. You can't predict their futures. This is only evident when looking into the past, and yet it becomes very powerful for thinking we know what the future is going to be. We don't. Nobody can predict the future. None of this is predictable. So maybe perhaps we convince ourselves that the professional managers of this know what they're doing. And certainly one answer to this problem is rather than buying individual stocks, one or two or three of them, let's buy a bunch of them and average them all together, particularly from different sectors. Buy some automobile stocks, buy some banking stocks, buy some food stocks, et cetera. They're not all going to go through the same calamity at the same time. They're going to have different problems, perhaps, and maybe none at all. But averaging them together will hopefully, averaging a lot of them together will hopefully overcome the few that may go through some bad times. And that's a pretty standard thing to do. It's a really good thing to do, particularly in finance. We actually do that in science as well with some of our measurements and models that we gather when trying to understand our science. So let's now average together a bunch of stocks. And that's exactly what we're looking at. This fund here called Oak MX is an average of a bunch of stocks. This one over here, VFinX, is also an average of a bunch of stocks. VFinX is what we call a passively managed fund. It is actually managed by Vanguard, and they just went out and for the past 30 years, they have been buying the stocks in what's called the S&P 500, a very, very well-known index. And you can actually go to its wiki page and see the stocks that are in the S&P 500. It's no secret at all. OakMX, well, that's an actively managed fund, and therefore you got to pay the managers of that fund, and they have to, they're going to kind of keep their formula kind of secret about what they're doing. Otherwise, everybody just repeat it. So, but you're going to pay for that. But you're hoping that OakMX will do better than the VFinX, which is passively managed. And here it is, 2006. We see, yeah, it did do better. And now we're looking at 2006 to 2016, I think, right here, January 2016. And here we're looking at an investment of $10,000 in each one of these. And we see that OakMX came out ahead by about $3,000 ahead of the passively managed fund. So it's January 2016. Again, we look at this and say, well, OakMX looks like the one to buy. I think I'll buy that. So January 2016, we buy it. There's no difference between them. And in fact, right here through the pandemic, really wanted to own the passively, the cheap fund. Huh. Yeah, this gets really concerning, doesn't it? And so remember, keep in mind that when it's an actively managed fund, the managers of that, A, they have to be paid, so they're going to charge a fee, and B, they're often buying and selling stocks in less than a 1 year period. And that means they have short-term gains that you will pay the taxes on, and those taxes, those costs, fees and taxes are not necessarily reflected in this plot. So it's easy enough to sit here and say in 2024, well, maybe if I just wait it out, OakMX is going to come out ahead. So let's look at the entire history of OakMX, or nearly, starting in 1992 to present. And yeah, it looks like OakMX, compared to our passively managed, almost free fund, it's not free, but very, very low cost fund, comes out way ahead. Well, it really depends upon when you bought it. It turns out that right here in the very beginning, that's when OakMX outperformed the passively managed fund that follows the S&P 500. Instead of starting in 1992, let's start in 1995, just a 3-year difference. And now they're practically the same for all intents and purposes. And again, this highlights for us the great challenges when we look at individual stocks. These charts suggest that you can pick the right moment, then you'll be a successful investor. And that's true in hindsight. Anyone can go back in time and pick a winner. But no one sitting here right now can predict the future. No matter what they're saying on those investment web pages, no one can predict the future. So past measurements suggest the risks of owning a couple of stocks can be decreased by owning many, and that is true. And fund managers, the actively managed people who are putting together these stocks, they're carefully selecting which stocks they want to put into their fund. They need to be paid for it, and they can perform better than the passively managed funds that are just following a well-known index. They can do better than for a couple of years, but consistently beating the market, beating this S&P 500 investment decade after decade, no, they can't. And I have quotes at the end of this presentation by really smart people, as well as people who've done the measurements of this, that we'll go over in the end. So now at this point in the presentation, we're 2/3 of the way through. We've come to the conclusion that I think, and many, many others agree, that you should buy a broad market index fund. It's passively managed. It should have very low fees. That's an extremely low fee, and very low turnover, so you're not paying hardly any taxes on it. I want you to purchase as much of this in your IRA, and anything left over, put it into your taxable balance. And we're going to taxable accounts. And we're definitely going to see in the next couple of slides, reinvest the dividends. And then we're going to have to hold this fund for decades. So this is the S&P 500. This is the actual value of this fund. And now we're looking at a 150-year history of it. I'm getting this data, the S&P 500 data, from Robert Shiller, who is a very well-known Nobel Prize-winning economist from Yale. And he also tells us how much the dividends are. So these companies in the S&P 500, they will literally pay you to own their stock. It's called a dividend, which is really cool. And so if you reinvested the monies they were giving you, you'd follow this line right up through here. Now, this is really fascinating for us. Have a look at this. This is the S&P 500 right here today. This is the value. It's right around 5,000. You read across, yeah, that's the value on a log scale plot. But if you reinvest the dividends, look where you'd be. You're way up over here of 1 million. That's a 3 orders of magnitude difference. It's like going from $1,000 to $10,000 to $100,000 to $1 million. It's $1,000 versus $1 million. We'd all like to have 1 million, not 1,000. This is the plot that conclusively shows you reinvest your dividends. If I fit a straight line now to the reinvested dividend line, we see it's 10.5% from 1935 to present. But because we're on a log plot, it looks straight. If we plotted this on normal, it'd be like an exponential curve. So when people tell you that the market has gained 7% a year, that's this line right there on the S&P 500. 6.9 is what it actually is. Or if you reinvest your dividends, when they say 10% a year, that's what they're talking about here. And I give you the Excel spreadsheets if you want to download those for yourself to see those values. So now we've seen the S&P 500, we've seen reinvest your dividends, and now the fundamental question becomes, how long do you have to hold this? Is 10 years long enough? No. 20 years? Sort of. 35? Yes. There's a catch. We can't predict the future. So let me cut the video here, and then we'll do the last segment in the next video. Okay, so now let's have a look at the two types of investments that we talked about at the very beginning. We talked about the model where we are doing a lump sum investment, albeit $300,000 over 20 years. So a lump sum approach versus an annual contribution approach. Let's start with the lump sum approach. In the following four plots, I'm going to show you investing a $50,000 lump sum, not $300,000 like before, but a $50,000 lump sum in the S&P 500, reinvesting your dividends. How much money could have been made on that one-time $50,000 investment? We're going to look at four different plots. And across the bottom, we have a 150-year history down through here. I'm going to encourage you to pay attention to basically from about 1950 to present. And that has to do with when the SEC was created. We can talk about that later if you like. So we're going to look mostly at this data in through here. I'm going to keep this scale the same over here so that you can see the difference between a 10-year amount of time versus a 35-year amount of time. So let's just start and look at the plots, and then I'll explain to you what these plots mean. Just watch how these values grow over a changing time window. That's a 10-year investment. There's a 20-year investment window, holding the S&P 500 for 30 years, and finally 35 years. That is a phenomenal amount of money. Now, let me show you how to read these plots. I'm going to go back a little bit here. Let's go to this 20-year window. Let's pretend it's 1990. And you want to sell your investment. So you bought the S&P 500 in a fund in 1970. So 20 years before the plotted value on this axis, there's the 20 years. So it's 1990, and you are going to sell what you purchased 20 years before in 1970. So you bought, we'll go all the way back here, in 1970, you bought the S&P 500 here, and now it's 1990, you've gained in value. How much money did you make? Well, here we are in 1990, you invested $50,000. So we read up from 1990 to, and we reinvested dividends, and where we cross the blue line when reading up, we read over, and you made about $450,000. Your $50,000 became $450,000. Be very pleased with that. We can do this with, let's say, the 30-year window. Here's the 30-year window. Let's say it's the year 2010, and you purchased the S&P 500 fund 30 years before 2010. So you purchased that in 1980. So then 1980, 30 years later, you sell. So these are the values that you gain by selling this much time later. So here we are in 2010, and you sold your $50,000 investment. You read up and across, and you have, looks like about $1.25 million. You'd be very pleased with that. And this dashed line in through here is that expected 10.5% annual gain. So any of these values above the dashed line make us happy that we did better than expectation, whereas these values here, 30-year investment, is below the line here, and we're going to say, wow, we're not too happy about that. And so what we see in all of this is that 10 years just isn't enough time to make really the kinds of gains that we're trying to achieve with this lump sum investment of $50,000. 20 years, at least, we're getting somewhere recognizable as a solid investment. 30 years is beginning to make us feel comfortable. And 35 years, we're seeing that a lot of the values are actually above the expected line. And indeed, the average of all this going up and down is about $2 million. So what happens in this plot is our lump sum investment of $50,000 over a 35-year window made $2 million plus or minus $500,000 in the past. These are looking in the past. I don't know what the future will be, but this is what the past was like. I encourage you to go ahead and get the spreadsheet and enter into it your own investment window and calculate how well the S&P 500 with reinvested dividends might have done for you. So that's the lump sum approach. Let's now have a look at what would happen if instead we did an annual contribution to our investments. And so here we're looking at the S&P 500 starting in 2010. We're going to make $7,000 per year investment. We're going to grow that investment at 2% a year. And over 10 years, the total investment will be $78,000. And here's how much money we would have made. We follow this green line and we read up and over, and we're above $140,000. And that's doing better than the model, that expectation. So we're going to be quite happy about that. But maybe you don't have the confidence to do this yourself, and you're like, okay, I'm going to pay somebody. 1% doesn't sound like a lot. I'm going to pay somebody else to do this for me. And so therefore, you've got to pay them, and therefore you're investing less, and you're going to follow the red line. That difference doesn't look like much here on this scale. Let's now show you what it looks like on the actual scale over here, where you can see those dollar amounts. This is how much you paid. You lost out on $8,500. How much you actually paid is the running sum right there, but because it wasn't invested, you lost out on $8,500. Well, you're probably kind of happy nevertheless, because after all, you're doing better than the model that we see right here. What happens if we invest for 20 years? The total investment is going to be around $175,000. I need to add that in down there. Oh, sorry, right there. I had to go to here. I was on the wrong plot. My apologies. So we're going to now go back to the year 2000 with a 20-year timeline of investing, and we're just going to invest $7,000 per year, 2% growing per year, and we see that okay, we came out to about $475,000 after 20 years. We were doing it at least as well as we were meeting our expectations of the model 10.5% until we hit the Great Recession. And we're struggling to come back to that. And more recently, we have gone past the model. So recently we're happy, but 13 years, we're kind of sad. And here we're paying, if we're paying someone else to do it for us, how much did we lose out on? $50,000. When people ask me, how do I pay for my kids' college education? I say, well, do this yourself. Learn how to do this yourself. It will quite literally pay you. Here, $50,000 in this particular example. Now let's drive the point home. Here's a 35-year investment starting in 1985, reinvesting our dividends in the S&P 500, so a fund that did that for us. And we see that $7,000 per year would have been a total investment of just over $350,000, and we would have gone well past our $2 million goal. So that makes us feel very good, unless we are paying someone else to do it. How much did that cost us? $500,000. So the final point I want to make to you is you can pay someone else to do this, but it most definitely pays you to learn how to do this yourself. And quite literally, $500,000. The quarterly fee that you're paying hardly even shows up each quarter. If you're running sum total all those fees, it maybe amounts to, it looks like about $175,000. But because that was not invested, you got to pay the manager. That's their money. They're doing this for you. And so you did not get to invest that money, and therefore you lost out on $500,000. Clearly it pays. I'll do one more way to implore you to learn how to do this yourself, and that is this. My now 80-year-old mother, 5 years ago when she was 75, opened her own Vanguard account. She did it. You can do this too. So here's a summary of the things I would like for you to do. Open an online brokerage account with Schwab, Vanguard, whomever, with a good reputable online company. There's several of them. Buy a passively managed fund with low fees and low turnover. Keep your taxes to a minimum. The fund should follow a well-known index. I advocate, as many people do, the S&P 500. Reinvest those dividends and hold for 3 decades. Better get started now. Put all this in the maximum amount of this investment into your IRAs, and the rest can be in your 401k or in a taxable account. We can talk again about the differences in those taxes. We didn't talk about bonds. We didn't talk about your value in your house or maybe commodities. I want you to read up on that and read about a typical split between how much money, maybe 80% into this S&P 500 fund, and put the remaining 20% into bonds. Most of all, I want you to control what you can control. You can control fees by not paying someone, by learning how to do this yourself and quite literally paying yourself hundreds of thousands of dollars, not paying someone else. You can control taxes by buying funds that have a very low turnover, and therefore they're not buying and selling throughout the year, and therefore not having capital gains taxes that are short term and therefore high tax rates. And most of all, you can control your emotions. The fear of missing out is very powerful. So many times we get whispers in our ears and we start reading online about somebody who got rich quick. You never learn about the people who did not. And there's plenty of people who did not. I hear those stories and they're very frightening. I don't know what's going to happen in the future. Absolutely no one can predict the future. I'd be delighted to answer those kinds of questions with you as well. Right now, ask yourself this. Can you predict the future? No, nobody can. So don't get the idea when you read online that somebody else is predicting the future. They are not. These are the quotes I promised you. Burton Malkiel, he's the dean of the Yale business, former dean of the Yale, retired now, and he wrote A Random Walk Down Wall Street. Oh my goodness, please, please, please read that book. Here's John Bogle. He founded Vanguard, managing $7 trillion. And here's Warren Buffett. We all know who he is. And all three of them are saying to do the things that I've said. I'm just a parrot compared to them. And finally, those fund analyses showing active versus passively managed funds. Here's some quotes from the people who actually analyze that, actually go into the data and analyze active funds versus passively managed funds. And yeah, active managers do better than passive funds for 1, 2, or 3 years, just a few years, but not decade after decade. So thank you very much. I'm happy to help, and I wish you well. Please feel free to contact me.